going on in San Francisco and in Milan. Obviously, for me in San Francisco, for Mr. Radigan there in Milan. And then the face of happiness, Mr. Glenn Freiberg there in Chicago. Gentlemen, how goes it on this Fed day?
I put on my Sunday best, for Jerome and the Fed. But lesson learned, never again. It's black T-shirt, and I'll throw on my.
It's funeral attire only for.
Even if
for
you just
Fed
need to
days.
wear glasses with a non-corrective lens, just as a style point, Glenn.
I've got contacts in, so I just objectively made the wrong decision today.
Okay, that's all right. I mean, listen, I make probably 50 wrong decisions an hour. So.
Thanks for having me, guys.
If you only made one wrong decision today, you're doing very, very well.
Indeed.
Well, you know what made the right decision? It seems like every market priced it perfectly. What do you say?
Priced it perfectly. I mean, that was what we didn't get into that with Tom and Tony, but what I was thinking when we were talking was it actually speaks to both the Fed's good job on the Fed for sort of conditioning expectations to the point where they were on the pin there, and good job on the market sort of guiding the Fed to the pin. In the classical tasty trade world, this is about as good as it gets in terms of selling vol before the news and cleaning up after the news.
Well, let's take a look at the charts here because they are interesting. This is a chart of the S&P, and what I have here is a 30-minute chart. So one of these bars is 30 minutes, and obviously it doesn't take a genius to figure out this is where the Fed policy announcement is. But I would point out this long wick to the downside, which tells you what the markets thought of this. Now, without quibbling as to whether the markets wanted more cuts or fewer of them, I think that much is clear. I think you look at this and you go, well, it seems like the market was moderately displeased, but not in any kind of a way that mattered, at least for today. Because clearly what we have is, they cut. That rally doesn't hold. We then sell off aggressively and finish the day unchanged. So in my mind, the market priced this well-ish, but clearly this wick would tell you that at least in its initial reaction, the market didn't like it, or in essence wanted more dovishness than it got. If you consider the response from the dollar and from bonds and from gold, you also get some interesting dynamics here. So gold, similar story. It initially didn't like it because ostensibly it thought that this was less dovish than it wanted, but ultimately didn't go anywhere. While we're on the metals, let's take a look at silver here. More convincing of a disappointment, but it's silver. It's jumpy. Let's look at something that isn't jumpy, usually the euro, and for that matter, what that means for the dollar. And you find that, again, initially, good, rate cut, but then the dollar ends the day stronger. And you see that across sort of versions of the dollar. Here's the pound. It ultimately looks unchanged, but that's after it erased all of a very significant intraday rally. Here's the yen. It is down, having erased an attempt to extend higher. Here's the Canadian dollar, where we also had a rate cut today. It's a little bit more convincing, but of course, they also cut rates, and theirs was also expected. So it does seem, to me anyway, that the initial kind of response from markets was, this is not what we wanted to see, but we're not sure if it's anything we need to worry about. And so we'll see now where the dust settles. But ostensibly, the readout from the markets is, we wanted this more dovish than it turned out. Thoughts?
You're saying that because of the absence of, you're saying the absence of a rally is the evidence of that opinion?
No, I'm saying it's not just an absence of a rally. There was a sell-off. That sell-off just didn't hold. But the response, I mean, here's NASDAQ. What did it do on the news? It went down here.
Mm-hmm.
Now,
I mean,
by the
again, the buy and the
close,
dippers are there within an hour. I mean, it lasts
it
nothing.
will exactly. And so we end up unchanged. And so now we find out what all of this means with a day of digestion. I mean, this is the policy announcement. The response is negative. We then come back and ultimately end basically where we started. So, on net, is this a market that's happy with the outcome? I think very clearly no. The question is it unhappy? And I don't think we know that yet.
Yeah, I think equities are harder to read from this in terms of sentiment, but what did surprise me is how unchanged or like the dollar is and gold as well. Because we had the run up to a lot of key levels. I was looking at spot markets, but looking at, the euro hit 119, Australian dollar hit 67 cents. We saw a lot of ambition running up. And then when that was erased and the kind of outcome was, okay, dollar a little stronger, it did surprise me that we didn't then drift even stronger in the dollar's favor and in against gold as well, just because of the week we've had so far. Monday and Tuesday, kind of the run up into this announcement, felt like more of that dovishness was baked in, priced in, that it surprised me that we didn't even settle, as low as we started the week in the euro and gold. So
this is a very, very good point. I mean, take a look at what gold did here, in case you were wondering whether the market thought that this outcome was in line or not. I mean, it's not rocket science here. We saw gold rallying into the news. The news came. We see these large wicks here where the markets thought about the news. It went this way and that way, and then it resolved. And gold went down.
But what sentiment does gold represent at this point? I mean, I don't even know.
I think gold represents anti-fiat and anti-interest rate sentiment usually. And so if
you're saying the gold weakness means not as many rate cuts as soon as we would hope on the margins, and slightly stronger dollar.
Yes.
I mean, this couldn't be, we're shaving truffles.
Well, and again, when you look at where things actually closed, you don't have conviction. What you have is zooming in on what this is, which is a 15-minute chart, and going, here's the market's reaction. They reacted in a way where they got something less dovish than they wanted, but they're not prepared to lose any sleep over it today. And the question is, does this calculus change tomorrow? While we're here, let's take a look at the actual forecasts and what the Fed actually said, because I think that's an important part of this equation here. And I'll put it up on the screen so that we can see. Here's the Fed's summary of economic projections, and I think the meat of what we need to focus on is right here. So take a look. What do we see for expectations? Growth expectations were revised higher, not lower. And you see it across the entire outlook here. Higher, higher, higher. The unemployment rate was revised moderately lower. Lower for 2026, lower for the year after. The inflation outlook mostly unchanged, but for next year a little bit higher, ostensibly because the pass-through of the tariffs continues. A little bit higher both for headline and core. And take a look at what happens with the rates projections, because this is fun. So we were looking for 50 basis points in cuts in June. Now we're looking for 75. And relative to this year, we still only have one cut that's priced in for next year. from 3.6 to 3.4. So the actual pathway from this year into next and into 2027 is completely unchanged. What we've changed a little bit is how many rate cuts we have on the menu for this year, which, by the way, to Glenn, to your point, the market's already had that third cut mostly priced in. If we take a look at what these expectations looked like, here's October, and you can see that for October, yesterday, 69% chance of a cut, today, 82. A week ago, 68, now 82. We knew the second cut was coming in October. It's there. Here's December. Here's the third cut. A week ago, 68%. Now more certain, but we're in any case looking at a situation where both of these cuts at these next Fed meetings were, for the most part, already in the forecast. And so when we then look at what the Fed did here, in keeping only one rate cut for next year, this is, I think, where the disappointment comes from. Moreover, this change here, these three cuts that we now expect for this year, take a look at what the actual dot plot looks like and tell me if you can figure out where the Trump administration's nominee marked his dot. So here's Fed officials here, right? And you can see that there's 9 of these that favor a more hawkish view. There's 9 of them that favor a less hawkish view. And then here's the break. I mean, clearly,
You think that's the next
this
Fed chair?
average is more than a little skewed.
But
When one person is calling for, what, 5 cuts?
But that one person might be in charge in, what, 5 months?
Well, that's not how the Fed works. And Powell answered this today, right? So the Fed chair can't make these calls solo. But it is certainly interesting that we have, sort of very clearly the introduction of a view that contrasts dramatically with the rest of the committee, and that this will now be a feature. And we'll see, Glenn, to your point, how this evolves. But the forecasts here, they're not dovish. They're not dovish at all. In fact, the Fed is saying they're going to cut only one time next year. The market thinks it's like 3. And that probably is how you end up with this kind of kind of disappointing, but not anything to run away with today kind of an outcome. That slight kind of tinge of disappointment, that feels like where it's coming from.
So the slight run-up was, or the instant reaction was, okay, this looks dovish when you sum it all into one number, but then when you start digging through it, there's so much uncertainty and dissent, perhaps, that you can't really put as much weight to the aggregate number. And Powell kind of spoke to that as well, saying that it's meeting by meeting.
Right. And I mean, that's not necessarily unusual. You've had that be a mantra for the Fed for a while here, but I think that's how you end up with gold spiking lower, with the dollar erasing its losses. I mean, here we have the euro again. I mean, obviously the euro was all the way up here, and then this thing comes out, and not only does it erase all of those gains, it actually finishes the day a little bit lower. I mean, here is, if ever you wanted to see a perfect distillation of what the market thought of this announcement, here it is. Rate cut. Wait. Hold on a minute.
You're suggesting that the weight is not as many cuts as we'd hope for in the future, or the weight is growth slowing, we're cutting rates, or some combination thereof?
It seems like not as many cuts as the markets thought was the essence of the reaction in the forecast. And also, the revisions are not dovish. Growth is revised higher, unemployment is revised lower, inflation is revised higher. They're not big revisions, but those are the revisions.
The marginal movement is slightly more inflation and slightly less jobs.
Slightly more jobs.
Slightly more jobs.
Yeah. So this is not a revision that would tell you the Fed is in dovish extrapolation mode.
Mm-hmm.
In fact, there was one comment from Powell that I thought was particularly telling. He said, you can think of this as a risk management cut in the context of the risks the labor market having risen.
Mm-hmm.
But this is not, oh my God, the economy isn't good kind of a cut.
Man, the dollar at $1.18, huh?
Yeah.
Terrible.
Yeah. I mean, and
so I mean, it just seems like a hell of a nice time to get long the dollar, especially when you do have the possibility of the tariff Supreme Court madness next month.
You do, but that's next month. And it seems like here, just looking at the liquid futures contract here for the euro, I mean, if ever there was a spot to find a top and start to head back lower, I mean, this is like the front first page of a chapter on support and resistance in your favorite economics or your favorite technical analysis textbook. I mean, oh, look, a former high. Oh, look, we tested a former high. Oh, look, we failed the test at a former high. So if ever there was a spot, this looks like a good one. I'm already short the euro for what it's worth, and I'm a little bit upside.
Using FXE or using futures?
Using micro futures. So I'm outright short M6E. And you can actually see it on the screen here where I'm short. So I'm short a little bit underwater here. I got in a little bit earlier. You can see actually the dotted line here where I did. So there's been a few days here that this has gone a little bit the wrong way, but I still have the position and I don't see any reason to get out of it. By the same token, though, I'm long the pound. You can see where I did that on this break higher here. So I'm not one-sided on the dollar. We'll see what the Bank of England does overnight. I have a mind to hold this for now, but my sense is that the dollar is probably done falling.
And for the dollar and gold and a lot of these global assets, do you think all the players that wanted initial reaction are in, or do you see some substantial moves in the Asian session, the European session tomorrow, before we get another look at it in the U.S. session?
Oh, absolutely, and I think that's a very good point. The Fed comes in relatively later in the day. I mean, we're talking about what 2 p.m. Eastern. By then, European markets are closed, and so especially the liquid ones like Frankfurt and London and Paris, and so Milan, and so you look at this and you say, okay, well, Europe hasn't done anything on this basis yet, neither has Asia. And so we're going to see what the follow through is, if any, overnight. I think certainly the U.S. markets are how they open tomorrow and what happens with the benefit of a little bit of a digestion will be, I think, an important question, because the markets kind of, they didn't get the dovishness they wanted, but they also didn't get hawkishness in a way that's spooked them for now. So now I think basically the markets have to decide, and maybe tomorrow we'll get the first signs of what that decision is. But if the hope was that expansive Fed stimulus is going to keep the rally juiced, we don't see evidence of that here.
Yeah, I think in my mind, overnight gold's the most interesting. We'll be able to see how much. I think the Asian session is really interesting for that, right? I mean, they've been propping gold up from a demand perspective, and we'll be able to see how much of the gold market right now was betting on those lower rates quicker versus risk sentiment. I don't think we know the full picture from the equity reaction, like you said, until tomorrow. So I don't know. Do you see metals moving drastically in either direction?
Drastically, maybe not, but we'll see. The dust is still very much settling on this. Dylan, yesterday when we spoke on this show, we were talking about you're going to buy them hand over fist this morning, and just avoid thinking at all costs and keep buying NASDAQ. Is that where you still are?
No, no. I mean, I believe we should. I'm not. I am strongly of the opinion, and will implement the opinion tomorrow, of a short NASDAQ, short gold, long dollar. I call it the Radigan triple.
I like
I
it.
believe we have come to an inflection point going into the fall. I believe the price levels are absurd in the NASDAQ. I believe they're preposterous in gold. And I believe they're an outrage in the dollar. I think all three are on meaningful price extremes. And I actually am shocked at the lack of, that the implied volatility is where it is on a lot of these things. And so I just think it's actually a beautiful time to be short the NASDAQ, short gold, and long the dollar. Obviously, there's a huge amount of risk for me in that by virtue of all the thinking involved. But
it does involve thinking.
With that said, I just think price extreme rules the day. I'll put it on small, and then if it starts to work, I'll get bigger, I suppose. But
that would be the way I'd do it.
And I'm inclined to do it, with openly directional put buying, honestly, on the NASDAQ and on gold, and maybe calls on FXE calls or some such thing on the euro.
Well, I mean, if we look here, just really basically, and say, okay, let's say we come into 2,300 on the NASDAQ as like an initial sort of thought process for a pullback. If we wanted to look at what, and let's go risk defined here, what a put vertical would look like here, and let's say we'll go sort of tasty methodology adjacent, and we go, in this case, 44 days out. If we take a look at a move back, let's say, over here to like 23.5, and why there? I'm just looking at pockets where liquidity seems to be, to look at sort of some sense of getting filled. And obviously this is after hours, so it's thin. But if you look at the risk reward here, I mean, it's fantastic. I mean, we're talking 3-to-1 almost. So the vol is cheap enough that even just a simple vertical like this is going to be asymmetrically enticing. If we wanted to get smaller, we could say for example, the micro contract for NASDAQ. And let's do this same exercise here. So from where we are just at the money, out same distance here. Again, not a, I mean, basically a 10 times difference, but the risk reward holds and still looks incredibly attractive. And if we did it even smaller as far as capital allocation and did it in ETFs with the Qs, again, same exact exercise, and we'll go to sort of a comparable level here, let's say somewhere here, give or take. I mean, again, not quite as amazing of a risk reward, but still very, very impressive. Even if you sort of hem it in and say, okay, you know what, I'm only attempting to go down to 580 on the Qs, which, I mean, obviously, if you wanted to go to the same levels here, you'd be all the way down to 560 or so. But even just a pullback into here somewhere, you still have very, very good risk reward, at least 2-to-1, that you lock in a risk defined way, because that's how cheap this vol is. So even in a risk defined, way, I mean, if you were going to bet here, do you bet long, or do you take at worst ish 2-to-1 risk reward in a risk defined way to bet on even just a modest pullback? I mean, the pot odds just, they scream short at me.
I couldn't agree more. I mean, can we flip through gold for a second? And
Absolutely.
then the dollar?
Absolutely. So let's do this same exercise with gold. So here's the active gold contract. If we get a pullback, let's say from here, and again, let's be modest. Let's get a pullback down to this former high from late April. Let's not get greedy. So back down to 3,600 ish. If we did that same exercise, and again, let's do it 41 days out. Although I would probably err on the side of 68.
I was going to say, does this the tasty 45 days hold in this exercise? Just as a thought experiment, does that align with your thesis of?
So we're using it, or at least I'm using it here as a kind of variable to hold constant. Mm-hmm. But recently, what I've been doing is reducing my delta risk, my directional risk, by looking at longer term durations. And with the bonds, man, that really helped. I had a 80-day spread on, and it had to go 70 days to really work. But in those last 10 days, they paid for all of my sins wanting to short the stock market and then some. So thank you, bond market, and thank you, extra duration. So if we wanted to go, let's say even to 3650, we're not even going to get very excitable here. We're saying like even to here or something like that, where we have a pocket of a pocket of liquidity. That looks like about 1-to-1. If we went all the way to 3,600, you get a little bit better. Although I would argue this is not the world's greatest risk reward. And it's probably because if you look, whereas NASDAQ had IV rank of 15, we're at 27 here. So vol is a little bit more expensive. And I suppose you could approach this by selling calls and doing it this way, where rather than essentially looking at it from a perspective where you're sort of outright just buying puts, betting that this thing will go down, maybe you sell somewhere around here and maybe you allow it space. If we look on the chart here, where's our top? Let's say we can, I mean, we can keep this pretty tight. 70, 75 maybe. So if we consider that sort of right here, perhaps something like that. Now we can see, okay, I mean, this is starting to get close to 1-to-1, and obviously this would result in a credit. So not bad. I mean, when you can get close to 1-to-1 selling vol, pretty good, considering you're obviously a premium receiver. So that might be a better way to approach this side of it. Again, if you wanted to do this smaller, you could do it in ETFs. So you could take GLD and you could go 44 days out. And if you did short put here, you might say, okay, let's pull back to the top of this range, like 318, 320. That would be, let's say, something like this. Let's say 322 to go where the liquidity seems to be. And not bad. Not bad at all in the ETFs.
2-to-1-ish.
2-to-1-ish. Not bad at all. And if you wanted to do it the short call version, then let's say you let yourself go up to 340, 345, something like that. And then you'd say, okay, even if you kept it this tight, again, about 1-to-1, if you went out to 345, now you're getting a little fuzzy. So unless you'd want to keep it real tight, doing it through GLD and keeping it simple and just buying puts, pretty straightforward.
Yeah, I mean, what's the case against my naked put buying mentality other than the obvious?
I mean, the reason that I like using verticals here is, number one, I like having defined risk because these markets are funky. And so I like basically forcing attractive risk reward onto the position and basically say, you know what, I'm going to make sure that as I roll this dice, the odds are in my favor. The risk reward is in my favor, and I'm going to lock that in up front. And if that means that my worst case scenario here, let's go back to this version of events here. I mean, the way that I would structure this would basically be if I've got, let's say, about 20 grand in this this account that I use for the Tasty follow page, where I put all the trades that folks can see, and you can see the risk here is about $500. I might hem this in a little and get the risk down maybe to something a little bit more manageable, such that I'm not risking more than, let's say, 2% of the account. So I might do something like this, and obviously there's sort of room to fudge it, but maybe something like that, and basically say, okay, I'm going to risk 235 in a 20 grand account to be almost 2 to 1. And obviously, this is after hours on a ETF. So we'll see what these quotes are and what this liquidity is when the markets reopen. But easily, sort of the best 2 to 1 bet here seems to be something like this. And you can see why it's good. I mean, the volume here is much higher than anywhere else you look. If you wanted to go further out and you wanted to say, you know what, I'm going to give myself all kinds of time, then things get really interesting, because then you could pull this in to maybe hear something, maybe a little bit more, and your risk reward still looks very solid, and you have lots and lots of time and less immediate sensitivity to what's going on with directional risk. So you could give this some time to kind of figure its way.
Mm-hmm.
What's the
And then long dollar?
For the dollar, I think the most straightforward way of doing this is actually to just outright sell the micro future. And I think here, the most kind of direct way seems to be, you know what, don't get all stuck on options for this version of it, because then you have to start thinking about, well, which instrument do I use?
You don't like
UUP?
FXE puts?
I mean, if you did FXC, let's price that out here. So here's FXC.
You're also getting, if you moved over to the spot market, long dollar right now does yield you positive carry. So if
We're
you're
gonna
less
get there in
certain
just a
on,
second.
yeah,
But yes, you're absolutely right. And in the futures, the difference is that positive carry is already baked into the contract. So you're getting the positive carry, whether you're in the futures or in spot. In spot, the positive carry is a thing that occurs independently of the spot price. In the futures, it's already baked into the price of the instrument. So lest you think that the market is going to give you an arbitrage opportunity, it is not. Whereby, let's say you sell the spot, buy the futures, and extract carry. I can't tell you how many people have brought that idea up over the years, going, well, if spot earns positive carry, futures don't have carry on the face of it. Of course they do, but if you're not terribly familiar with the way a futures contract is structured, it's not the way spot is, where every day you some carry either adds or subtracts from the account. And you go, oh, well, fantastic. I'm just going to directionally neutralize everything, be long carry in spot, offset the direction in futures, and just collect the carry. Sorry, markets are too smart.
heard you. The last pitch for that little TastyFX tab I will give, though, is you would save on commissions. Commission free TastyFX.
And,
there you go.
And we'll get there in just a second. I think that there's really, I mean, the capital efficiency argument, I think, is by far the most compelling. And we'll get there in just a second. I am, by the way, so I started my trading life in spot, and I love it dearly. So you get no beef from me there. If you wanted to look at FXC here and do it this way, let's again do a. I mean, I suppose you could, again, in a straightforward sort of way, say here, okay, we're going to buy a put vertical, and let's say we aim for a meaningful euro turn. So let's see, down to 105, let's say, just for the sake of argument here. If we went 93 days out, I mean, the risk reward is fantastic. 3 to 1.
Mm-hmm.
I mean, that's excellent.
What's the
and again,
problem?
I mean, there's a couple things here. It's not very liquid.
Big problem.
Not the biggest issue, but it's
Still a
there.
problem.
It's there. I mean, getting fills is fuzzy. I generally like to do currencies in either futures or spot because things do happen outside of US cash equity hours. And both the futures and the spot let you get out if like the ECB or the Bank of England does something that your position doesn't envision, or the BOJ does something wacky, or China says something odd and the dollar goes haywire. If you're in the ETF here, you're not doing anything about that overnight. If you're in the futures or in spot, you can adjust your position right there. Looking at spot, I think the biggest and most compelling argument for spot, and you can see, I have a trade on here. Where's my dollar yen position? So I'm a little bit long the dollar against the yen here on the spot side. Why on the spot side? Because there is no good way to do it on the futures side. 6J is a huge capital intensive position. And if you wanted to do verticals even, it'd be expensive. Again, it depends on the size of your account, but still. And there's no liquid options on micro yen in the futures market. So for me, dollar yen as a spot instrument to be essentially short 6J in spirit, that makes a lot more sense. Moreover, you could really adjust the size here. So point one is essentially the same as what would be a micro 6J future. So it's a 10K lot. If you wanted to, you could go. How low could you go here, Glenn? 1K. So
yep.
0.01 of a standard 100K lot. So you'd end up. I mean, you could, if you were not sure, and if you thought, you know what, I don't know about currencies, whatever. I don't have any confidence in the dollar. It's had a terrible start to the year, but it does look like Dylan's onto something. I'm going to take a stab. On the spot side, you could put on a trade that's 1/10 the size of a micro contract. So 1/10 the size of M6E. You could do here, let's say if you wanted to look at the euro and you wanted to go short the euro the same way you would outright go short M6E. If you wanted to do this and do it like that, you could do it. And you'd have relatively small exposure.
Right. Margin, at 2%. So that you could get in there for $25.
You'd make less money also if you were right? So there's all the options there. But in my mind, I think, and obviously I'm doing it this way, the most straightforward kind of capital efficient way, if you wanted the full size micro, so you wanted essentially 10K in exposure, the future makes a ton of sense. As does the spot, by the way. If you wanted to just outright go short 10K Euro USD in spot, I've got that on as well. I have it on both ways.
Dylan, is the Radigan trade, is that also meeting to meeting? Or are you pretty confident through the end of the year?
No, I'd go meeting to meeting, and I would reevaluate. I would say the Radigan trade starts now, and I would be confident to hold it through the next meeting. And then I think, again, only a fool believes on Thursday the same thing he believed on Tuesday, no matter what happens on Wednesday. And so I think we have to maintain an open mind and collect new information. But I believe that that today is the day the Radigan trade starts. It's long dollar, it's short gold, it's short NASDAQ. Call your friends, call your neighbors. I think they'll be happy.
I love it. I absolutely love it.
I don't know. It's too bad Vecchio's not here. He'd probably be horrified.
Yeah, he'd probably tell us that we suffer from a
because
terrible.
the counter narrative, just to play Vecchio for a second, is
Yes.
the Fed just cut rates, told you inflation risk is higher than expected. Fed told you it's not going to cut rates as many times as everybody hoped, and the market did not fall.
Yes, I think that is a very fair assessment.
In the face, straight in the beak, and it held its own. It's still there.
Yep.
It's undeterred. It is unperturbed. And even in the face of being told you will not be getting as many rate cuts as you might hope, even in the face of being told that there is a little more inflation than you'd like to know about, and even being told that the Federal Reserve will not be doing as told by the grand and mighty President of the United States, the stock market's like, okay. Like, it took a punch today, and it's okay. And maybe this is just a moment of gathering itself before it launches forward in more thoughtless madness of a supernova.
Maybe. That is, I think, entirely
that would be the argument, or Radigan of 2 days ago.
Totally plausible. And I think very fair as a readout, where you go, you know what? Obviously, the market didn't like it because of those downside wicks, and then it shrugged it right off and said, you know what? Fine, whatever.
Fuck it.
And that's fair. That's entirely fair. I suppose we'll find out in.
And where do you come down between, stiff upper lip and call it off?
Well, so I'm going into tomorrow still long the metals, both gold and silver. And I think it's not difficult to see why. So here was the test of former range resistance turned support, and it held. So the up move is still there. So I didn't get out. Silver, similar story. You came back, you retested this former range top as support. That held. So cool. Okay, I'm still long. If it breaks down, I'll get out. And I'm a little bit short the S&P off of these highs here. So you can see where I got in here was basically right there. So still holding that. We'll see. And as we just said, I'm on both sides of the dollar. I'm short the euro, which, I mean, this looks very encouraging here. And I'm long the pound, which held a little bit better than the euro. So encouraging there. So I'm kind of on both sides of this, where my exposure in stocks is balanced by my exposure in the dollar and the metals. And I'm of two minds on the dollar, depending on the counterpart. So I'm straddling the fence. Tomorrow, hopefully, we get a little bit more conviction. And I'm probably going to make a decision and just pick a side. And some of these positions will go off and some of them will stay on, depending on what that side is. But before we wrap it up here, I promised in the green room before the show that I'd ask this, and I wanted to get your take on this, Dylan, and Glenn definitely weigh in as well. The president has come out and said that what he'd like to do is go from a quarterly earnings reporting to a semi-annual setup. So companies would have to report earnings not 4 times, but 2 times every calendar or fiscal year. So every 12 months. Dylan, thoughts? Is this
Yeah, I mean,
a
I
loss of
completely, I know, I agree with that. I mean,
transparency?
I believe that capital allocation and risk is something that plays out over 3 to 5 years for any
Mhm.
meaningful, any idea of consequence for to build a business or to grow a business or to do anything that is real as a business. I believe is a 3 to 5 year time window to have an assessment as to what's happening. And so I think it makes much more sense to check in twice a year in a meaningful way with a real audit and a real, a real temperature check on where we at and what's going on relative to reporting to investors, reporting to the entire sort of financial community and all the stakeholders in a given business. But I do think that the quarterly process is very burdensome, requires a tremendous amount of overhead to administrate, and incentivizes bad long-term capital allocation in favor of short-term strategies that can boost the stock price, for which many of the CEOs and executives have a compensation tied to the performance of the stock. And so they may not have a long-term contract at the company, and they have a strong incentive to goose the numbers in the short term through maybe things that are not in the best interest of the business over a long time, but are in the best interest of the management of the company at that time. So I've always thought that quarterly reporting creates a lot of incentive for bad capital allocation and bad decision making for the long-term interest of a business. And I think twice a year is much better.
I agree. I think it's sound, it's rational. There are a ton of variables, like time being one of them, going to semi-annual, or removing some of the hoops to jump through, like forward guidance. I think Buffett said that a while ago, of not being a requisite. So I think there are a couple things you could tweak to reduce that being such an overhead on companies and still give markets some indication. It would be an interesting exercise, nevertheless. I don't know if, as active market participants, if removing all of those quarterly event risk would be a little less fun. But yeah, from a company perspective, I think it makes a ton of sense.
I agree. I don't find myself, admittedly, in a lot of agreement with the administration on economic matters, but on this proposal, I concur. I think, and it seems like all of us do. In Europe, you already, if I remember correctly, in Europe, you're already for most markets at a semi-annual clip, and I think
Are they
going
the
to
role
a
models, though?
semi-annual reporting. Say that again.
Should they be the role models, though, Europe? Maybe they
In
didn't have
this
enough
sense,
growth
why not?
To report on it quarterly. We have
Well,
good
I mean,
numbers. Why not give good numbers every quarter? Here, more good numbers.
Well, as long as they're good, don't.
Now he's being a wise ass.
Somebody's got to do it.
You
And
don't want
taking
more money? Would you like some more money?
and taking pot shots at our beloved European Union.
Yeah, please.
All right, that's all I
Terrible.
got.
I think we're out of
Terrible.
time.
In fairness, there are major economies that report quarterly, but I think the essence of and the spirit of the proposal, that is, we don't need to spend all of the resources that companies spend every 90 days to go through this exercise. We could have companies report in a way that is less burdensome administratively, and the markets would fill in the gaps in between just fine without the song and dance. I think that makes sense.
Agreed.
With that, overtime is out of time. Thank you, gentlemen. It looks like we're heading into tomorrow with a reformed, bespectacled Dylan Radigan, ready to cut the head off the first 6 months of the year's moves. I like it.
Put him in the ditch, baby. Stick it in the ditch.
I'm with it. Don't go anywhere. I'll be right back after a brief commercial to dig in absolutely exhausting and exhaustive detail into this Fed announcement on macro money. So stay tuned. We'll be right back.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
If you've ever been curious about where to start with crypto, join me, Ryan Grace, for the Tasty Crypto Show. Alongside co-hosts and industry guests, we'll break down what's going on in the market and show you how to take advantage of crypto. No hype, no shills, just crypto know-how. Watch us live, join the chat, and fill your bag each week on the Tasty Crypto Show.
When the market moves, traders need to move faster. tastytrade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, tastytrade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on tastytrade.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new tastytrade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Delta, Vega, Gamma, Theta. It's all Greek to you. Well, guess what? Millions of people speak Greek, so you've got no excuse. Here's your alphabet. Theta is time decay. Time itself has value in the options world, and that value slips away the closer you get to expiration. Theta is how fast that happens. Tick-tock, time value drops. Delta is difference. How much does a $1 move in the underlying affect the price of the option? Long options have a positive delta because their value moves with the stock. And short options have a negative delta because their value moves opposite the stock. Gamma is get up and go. It's how fast delta changes. Gamma increases when the options start trading much more like the stock. Like the closer to the at the money and the last few days till expiration. Vega is not a Greek letter, but it does start with a V, and so does volatility. Vega measures how much the options price is affected by the changes in volatility. Now you know your alpha, beta, gammas. Well, gamma anyway. Pretty simple.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Dear Kaylee, hats off to you for being such a culinary genius. I don't think it has ever dawned on our kitchen staff to serve gazpacho hot. Sincerely, Bob.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
I don't want to fact check you with my vagina, but I will.
From the smart mouths at Tasty Live.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier, though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
The Fed rate cut is here, and the reaction in the markets is nothing if not interesting. What does all this mean, and where do things go from here? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to do here is unpack all of what just happened and try to make sense of where things are heading from here. There's certainly a lot to break down and a lot to consider, but the markets don't make it easy for us here today because what we end up with is not exactly the most convincing sort of price action one way or another. We end up instead with a sort of strange stasis ultimately, but the intraday price action does seem perhaps to be telling us at least how the markets read today's announcement and where it seems the overall story here is looking like it might develop, at least at first blush. So let's begin with that price action, and then we'll sort of back our way into what the makings of it might have been. So here's the S&P 500, and I think the most kind of glaring thing here immediately is it seems like we're looking at a market that wanted to go down and then didn't. So as we get the Fed news, we can see that things get a little bit soggy. The S&P dips down and then comes back and ultimately closes little changed. So a bit of a sense of maybe the markets didn't get exactly what they wanted, but also not exactly anything that the markets necessarily need to, at least seemingly, be concerned about. Then we look, and by the way, the NASDAQ looks about the same. We look at gold, and it's a similar sort of thing. Silver is a little bit heavier, but neither it nor gold ultimately break down beyond what was former sort of range top resistance. You can see it's now acting as support. This wick dips down. And again, same sort of readout. The market seemingly not all the way happy with this, but also not prepared to jump out the window on what the Fed is saying here, not willing to panic and get off its square. It's a little bit better sailing for the US dollar, and here the dollar is a little bit stronger. We're looking at the euro here as a sort of benchmark, and we can see here was the former swing high back in early July, and we end up tagging it and ultimately holding. So the dollar a little bit stronger than the signal we get, a little bit more convincing than what we saw in gold and what we see in stocks. Bonds ultimately don't go anywhere. They essentially remain locked within their range. Yields tick up just a bit, and they do it across the curve. The 30-year, the 10-year, the 2-year yields uniformly a little bit higher, but within the same range that we've been watching basically since the beginning of the month. So not really a strong signal one way or another, but the dollar does manage at the very least to head off what would have been a breakout earlier in the day with this extension above the high. And so the cumulative tone here, seemingly, well, gold didn't love it. Stocks didn't love it. The dollar was a little bit higher. And altogether, the sense is that the markets wanted the Fed to be more dovish than this turned out to be. And now they must decide whether they don't like it in a lasting, more meaningful way. Because for now, it seems like the end of day is kind of a head scratcher, but the ultimate kind of positioning and the ultimate response is hardly panicky or bearish or anything of the sort. So why did the markets kind of shrug at this? Why did they find this to be not what they wanted to see? Well, looking at the summary of economic projections here, we can see that for all of the conversation about rate cuts and so on and so forth, what we find is the growth expectations uniformly here got nudged up for this year, next year, and the one that follows. The unemployment rate revised lower. Steady for this year, but what revisions there were lower. Inflation, mostly steady, but what revisions there were higher. And then we look at the outlook on rates. This is perhaps the most interesting part of this equation. Now, the median rate was 4.4 before today's cut. We can see in June, the Fed said for this year, we're going to be at 3.9, so that's 2 cuts from 4.4 to 4.1, and then down again to 3.9. So that gives you sort of a sense for where we are now, which is 3 cuts narrowly. Now, that seems like it's dovish, but the markets had most of those 3 cuts already discounted before this meeting. In fact, we can see here's the expectation for October. The day before the meeting, we can see we were somewhere around 70%, and now we're around somewhere like 82 for a cut. If we look at December, the 3rd cut, again, somewhere around 68, 70%. Now we're at maybe 81 for a 3rd cut. So we were, and this is the most important bit, it seems, on both of these, well over better than even odds, even a week ago. Never mind the day before the meeting. So another cut in October was, for the most part, already priced in. In fact, well priced in. Better than 50-50 by a long mile. And then a 3rd cut, likewise. So if we then take a look at December, same thing. Well above 50-50 shot for a 3rd cut even a week ago. And of course, yesterday. Now, there's been more conviction in all of this, but it's not like the Fed is telling the market something they weren't already looking at. Moreover, when you consider what got you to these 3 cuts here, let's take a look at the dot plot, and you can see here is the range of outcomes calling for 2 cuts or less. Here's the range calling for 3 cuts or more. And we can see that 2 cuts or less and 3 cuts here is an even split, 9 and 9. And then we have one lone dot that apparently is so aggressively dovish that it's looking to see a much more expansive rate cut cycle, even just this year. It's calling for rates not to come down to the 3.5 to 375 range, but to the 275 to 3 range. So almost a percentage point more dovish than what the markets have in mind, certainly in what other Fed officials have on the board. And so we very, very narrowly arrive at this 3rd cut, and part of that is the median is skewed by this very out there dot. One can only surmise that's the dot for Stephen Myron, who the president just managed to squeeze onto the FOMC before this meeting. So not exactly the most dovish signal here, since the market's already had it discounted, and since the average is very clearly skewed by a single dot. The bigger story here is for next year, there's still only 1 cut. In June, it was from 3.9 to 3.6. Now it's from 3.6 to 3.4, but still just the 1 cut. And that, of course, clashes directly with what the markets have in mind. They still have 70 basis points on the board for next year. So that's at least 2 cuts with a strong 80-ish% chance of a 3rd. And of course, the question continues to be, if there is this disconnect, if this is what we are looking at here, then are we going to have a situation where the stock market is going to have to turn lower in a disappointed fashion because this looks like it's more dovish than the Fed is now routinely endorsing? And do we have a bottom in the dollar here because we're not going to get more dovish on this outlook at this point, and so the dollar is basically out of reasons to fall. Looking at the comments from Fed Chair Powell here, we sort of get a sense for which direction we might be going. First, we get that there's a slowdown in economic activity. The Fed chair thinks this reflects mostly consumer spending. And of course, we've talked here on the show before extensively about the GDP numbers take on this in the first 6 months of the year. We, of course, don't have third quarter data yet, but for the first 6 months of the year, GDP numbers give us the weakest consumption in 5 years, with the reference point being the first 6 months of 2020, which, of course, is the COVID lockdown. That is an ominous comparison. We see that the justification for the cut here is that the balance of risks have shifted with downside risks to employment. Labor demand has softened, and job gains are running below the break-even rate. That's after that revision of annualized figures where rather than having an average clip of about 150,000 jobs added after the revisions, we looked more like half that for the preceding 12 months. And so indeed, it does look like we have a significant rethink there. Perhaps the most critical part of this equation is the Fed chair is saying, I am not blessing what the market is pricing in at all. There was no widespread support for a 50 basis point cut today. Makes sense in the context of expectations. And perhaps most importantly, you can think of this as a risk management cut. Now, what does this mean in the context of expectations? Well, if the expectations are calling for an expansive easing cycle, in particular next year, the Fed chair is very clearly saying that is not what we're endorsing. This is more like a maintenance move because the balance of risks seems to be shifting, where before we were mostly concerned about inflation and not really concerned about the labor market. Now we're a little bit more concerned about the labor market. You can see from this comment here, Fed Chair says, I don't think we can say that policy no longer warrants a restrictive policy setting. And with inflation at a 7-month high and in the vicinity of 3%, it's seemingly logical why that is. So if the story here seems to be that the market wanted something more dovish and is in fact baking in something more dovish, we can see it with the naked eye right here. And if what the Fed did with their expectations is undershoot that baseline, well, then one might reason that the path of least resistance for stocks is lower, the path of least resistance for the dollar is higher, and what we choose to think about bonds and gold probably depends on the interplay between the rates outlook and whatever risk premium is in the market around uncertainty, not the least of which around things like the Supreme Court's impending ruling, perhaps as soon as next month, about the legality of most of the Trump administration's tariffs. Lower courts have said that those tariffs are conditional on invoking national emergency grounds are illegal. And now we're going to have to see what the Supreme Court says and whether they let the tariffs stand or they don't. But as we just spoke about on Overtime with Dylan Radigan momentarily before this show, a counter narrative and a logical one of that would be, okay, so the markets didn't get all the dovishness they wanted, hence this downswing, but they clearly recovered to be little changed into the end of the day. Ditto for gold. So is this really indicative of anything other than the market basically saying, right, this is not our ideal scenario, but ultimately this is fine? And marking resilience in the rally for gold, resilience in the rally for stocks, and we'll see what this means for the dollar, but the dollar maybe still has room to bottom. But again, this is not certainly a running away of dollar momentum, certainly not relative to this breakout out of this congestion range in the euro. One might think you would at least need to get back in here somewhere to make the case that the dollar is getting ready to run in earnest, at least from a technical or a price action kind of a perspective. So how this all filters through these markets over the next 24 hours should be very interesting indeed. And in the meantime, we are looking at a little bit more event risk overnight. The Bank of England is due to issue its policy announcement. The expectation is we're going to remain at 4% this time around. Rates are going to hold unchanged. But the really big question for the Bank of England and indeed for markets is going to be what the voting pattern here is going to look like. Because as it stands, the expectation is there's going to be fairly good conviction. 7 out of 9 policymakers on the MPC, the Monetary Policy Committee, voting for a hold, and 2 out of 9 voting for a cut. But it was really, really finely balanced in the previous decision. 4-9 for a hold, 5-9 for a cut. And that's largely around inflation in the UK looking more chipper recently. The numbers that we just got over the past 24 hours on inflation in the UK confirm expectations, 3.8% as expected and unchanged from the prior month. But that is nevertheless a repeat of what is or of what was in July at 3.8%, the highest in over a year, going back to January 2024, the last time that we were that high on UK inflation. Core inflation came down, again, as expected, from 3.8 to 3.6%, so nothing really to see there. But obviously, inflation is closer to 4 than it is to 3, and so much hotter than the Bank of England wants it. And so it'll be interesting to see how this calculus breaks out and what it ultimately means for the British pound, which held up a little bit better than the euro today. Positioning-wise, and from that perspective, I am going into this a little bit long the pound, a little bit short the euro. Still have my short put position and so long side in gold. My long calls spread in silver, so I'm still long the metals, and a little bit short in stocks. I've got a put spread in SPY, so keeping it small, keeping it risk defined, and straddling both sides of the fence. I am both long and short the dollar. I am both long the metals and short stocks. So I'm looking to see how this resolves into the end of tomorrow's session, and then I'll probably make some decisions on which side of the equation here to pick, and either the risk on or the risk off side, either the dovish or the hawkish Fed implication side, and we'll see how it goes. But as it stands, at least, the markets did not get out of the Fed everything they wanted, and the price action today speaks as much accordingly. And that's macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go there from. I am also commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money will be back tomorrow. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Regulation time may have expired, but the conversation is just getting started. This is Overtime, the post-market scrimmage for market junkies. Join Chris Vecchio, Ilya Spivak, and me, Dylan Radigan, as we analyze the X's and O's for everything from earnings to politics to macro events and more. Nothing's out of bounds on Overtime. We break down the news to provide you a playbook for your trades. Watch Overtime Monday through Thursday only on Tasty Live.
Frequent trips to Vegas, or there was a year I did a couple of them.
What's the most financially irresponsible thing you've ever done in your life? Doesn't necessarily have to be trading specific.
Financially irresponsible, that's a big question. Like people would say like going to college these days, I don't know. Renting, I like renting. I like the flexibility. I don't know. Maybe renting, I guess, by the book is financially irresponsible. Actually, you know what my biggest purchase right when I started my job was $4,000 on a PC setup, which was not a good idea at my salary point.
I mean, anytime you take a trip to Vegas, it's pretty financially irresponsible. I would say that frequent trips to Vegas, or there was a year I did a couple of them, which was pretty irresponsible.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
Tasty Crypto Show, and with me today is Shelly. Shelly, what's going on?
It always feels so incomplete because I'm always Shelly Van.
Yeah.
So you're like Shelly, and then I'm like waiting.
Yeah.
Like the hiccup that last hiccup that never comes.
I just got to get better at the intro in general. It's a little bit choppy.
It's all right.
Yeah, it's not consistent.
We've had a day, Dan.
Yeah, we have had a day, but we are matching, which is good.
Yeah.
So we are repping Tasty Crypto.
That's right.
Want to give a shout out to the chat. Thanks for being here, chat. Donna's here.
Donna's like the VIP of this show.
Yes.
This show is for Donna.
Yeah. Donna, we're here for you. We did we planned the whole day, this show for you. So do you want to give us a little rundown of what we're doing?
We are breaking down layer 1s versus 2s because it's all confusing in crypto land. And then you add in like layer 1, layer 2, like what? So here we go.
Okay. All right, let's do it. Let's get
Dive
into
in.
it. Again, this is for Donna. Shout out Donna.
Shout out Donna Ski.
All right. So why don't you...
Oh, and confession. These slides are a hot mess because we had quite a day and these had to be thrown together. So
yeah,
I have to preface, I would never with this much text on a slide. So apologies in advance, but here we are. Do you want to go ahead and just...
Okay, yeah, so again, what we're going to do today is just kind of give a rundown of what layer 1 versus layer 2 is in blockchain in crypto. So layer 1 is base blockchains that finalize transaction themselves. They maintain consensus, security, and economic value. Examples being Bitcoin, Ethereum, Solana. There's a bunch of others, but those are the big three. Layer 2 are protocols built on top of the layer 1, aiming to improve scalability, transactions per second, lower fees, faster confirmation, while relying on layer 1 for security/finality. So layer 2 you can think of as kind of a...
Well, I think, hold on, let's break it. Let's put this into lay people terms or just more simple terms. Layer 1, think of it like a 1-lane highway, okay, with a lot of security. And so you can get one car through at a time, all right, trucking along. It's nice and secure, it's safe, but it's slow if you want to add more people. And so if we use the analogy that, like, if one car is one transaction being put through on this blockchain road, all right, safe, secure, moving along. But what happens when you've got a lot of transactions to go through? It gets really slow, congested, clunky, and expensive because the protocols allow you to pay to cut the line. So as more people are coming onto this 1-lane highway, they're going to pay more to cut that line and get their transaction pushed through, but then the price is just going to get more and more and more expensive. So layer 1s are really safe, secure, but slow and expensive to use when there's a lot going on.
Right.
So layer 2s evolved as a scaling solution to make, like, public transportation. We'll package more transactions in a package and then settle it on layer 1, so it's still safe and secure, but now more can go through faster and efficient.
Yeah. It's kind of like adding additional lanes, but also with, like, big buses and big tractor trailers that can package more data or more packages to be shipped. Mm-hmm. And then the congestion fee thing is kind of like when you go to New York City and have to pay congestion fees for the crazy amounts of traffic there. So this helps it kind of, this layer 2, these additional lanes help kind of scale
the ecosystem.
Yeah.
Make it actually usable for more than just a few of us.
Right. Okay. So let's do a little picture for, let's kind of, we put this picture together, blockchain layers. You gave the analogy of a highway, single lane versus multi-lanes, and, you know, packaging data in public transportation. But this is sort of what we put together is it's kind of like a city in some ways. So this picture...
yeah, because to add more layers of confusion, there's not just layer 1s and layer 2s, there's a layer 0 and layer 3s.
Yeah.
So it's quite the onion. But yeah, layer 0 is the infrastructure that's connecting the separate blockchains.
Yeah.
So so let's just give some examples of a layer 1. You've got Bitcoin, layer 1.
Sure.
Ethereum is a layer 1. Solana is a layer 1. Now, these are all totally separate blockchains. I think people are like, wait, they're different? I thought you could have Solana on ETH and, you know, These are different blockchains. And then to add more to the confusion, when we're talking about the currencies, they have the same names.
Yeah.
So, like, Solana's a coin and a chain. Bitcoin is a coin and a chain. Ethereum is a coin and a chain. So it gets really, like, jumbled up and confusing. But layer 1s are a blockchain. Layer 2s are built on top of a layer 1 to scale my brain just died.
Layer 2s are built on top of layer 1 to scale applications and usability, right? Yes. Because, you know, I give the example of Ethereum, right? Bitcoin is a little bit different because Bitcoin was built for one thing and really one thing and one thing only, store value, you know, and you could say like internet money. But Ethereum was built for applications, was built to enable these decentralized finance and, you know, NFTs, some of this. And what happened is when they built it, there was trade-offs, right? So the trade-off was, in order to be maximally secure and maximally decentralized, they made the trade-off for, you know, the scaling trade-off, essentially. They went toward decentralization and security, right? As opposed to maybe bringing it a little bit more towards centralized, but scaling it more. So that was a trade-off they made. And, you know, as part of that, they ran into issues as more people began using it. It got way too expensive, way too slow, and you can't build robust applications. So what everyone thinks of as, you know, a great mobile experience, you know, pick any app. I mean, any app that you could possibly think, gaming, even Tasty Trade's platform, couldn't really work on Ethereum layer 1. But with layer 2s, you can build applications like that are performant, that are cost-effective, you know, lower fees, less costly, and just kind of resemble what you think of as a modern web app, right? But everything that happens on that layer 2 settles to the Ethereum layer 1, right? You know, Bitcoin, for example, the layer 2 there is stacks. There's a couple networks that have tried payment channels, essentially, like, you know, opening up peer-to-peer payment channels so that it's quicker, cheaper. But typically, Bitcoin is a 10-minute block time. It's pretty expensive. Microtransactions don't really work that well, but it's a store of value. It's extremely secure, and it's the most trusted blockchain out there. So, and then Solana. Solana took the opposite approach that Ethereum took, where it's a bit more centralized, actually a lot more centralized.
Right.
But it's very performant, fast, maybe not as secure, but or performant, right? Because there is downtime issues with it. But they traded that off for, I guess, a little bit more scalability, usability. So, but I think actually it's interesting because as more people use Solana, I think they're probably going to end up with layer 2s
right
at some point. So so this is just the way we're looking at layer 1 slide here. There's comparison, key weaknesses, risks. So now we'll go to layer 1, continue. Cardano, another one, Avalanche, Cosmos, Polkadot ecosystem, Sui, which we offer on the platform.
We offer all these on the platform, actually.
Oh, we do have Cosmos? I didn't know that. I don't think we do.
No, but we do have Dot.
Dot, yeah.
Okay, so yeah.
So we do have Cardano, we do have Avalanche, we do have Polkadot, and we have Sui. So all these are considered layer 1s. There's a couple others. These are the ones that we offer. And they all make different trade-offs. They're all built for different things. They all have different weaknesses or risks, but all of them are layer 1s. All of them, you know, are sort of that foundation for blockchain applications. So,
and this is important when you're operating in a more DeFi situation with a custodial wallet. If you have a wallet, your wallet address is going to be different for Ethereum versus Solana versus Bitcoin.
Right.
But any layer 2 on Ethereum, same wallet address.
Right.
So it gets confusing when people are like, but wait, if it's on the base network, it's still your Ethereum address. Solana, different. Bitcoin, different. So per chain is a different wallet address.
Right.
But layer 2s are like stacking on top.
Yes.
All the same wallet.
Yes. And that's for self-custody, like your browser wallets, like the Tasty Crypto wallet, MetaMask, Phantom. Yeah, because people do get confused about that.
Right, and it is confusing. So like if you're going to bring in stablecoin into your Tasty Trade account, you need to add your network on Ethereum, which if it's a layer 2, like if it's on base, you need to add it, that wallet, and then add it again for another network. If it's still a layer 2, if you're adding it from, pick one, Polygon or Arbitrum or, wow, my brain. Optimism, thank you. So if you have stablecoin on one of those layer 2s, you still have to add it again.
Yeah.
But it's the same wallet address. So customers are like, wait, but why? And it's like, well, okay. Crypto is still early.
Yeah, yeah.
Because at some point, all of this is going to be abstracted away. But right now, it's clunky.
But good to understand.
Yes. Very good. I think it's awesome to understand these things.
Yeah, so let's get on to layer 2s because I think people have some questions around that. So your layer 2 project / network, Arbitrum, Optimism, Polygon, ZK EVM, Base is the Coinbase one. Their base layer 1, what they settle to, what they send their transactions back to as for finality or the final confirmation essentially is Ethereum. So Arbitrum, pretty pretty strong TVL, pretty well adopted, meaning a lot of users or a lot of money is there.
TVL.
Great dev tools. There's some technical stuff here, optimistic versus ZK rollups, I think. There's different ways for the data to be packaged and confirmed on the layer 2 to be sent to the layer 1. We don't need to get into that today, but if you want to, if you're really interested, there's different ways that these layer 2s confirm or package the data that's happening on their layer, their blockchain to be sent to the Ethereum blockchain. So different ways of doing that, different data structures, different validation mechanisms. One being optimistic, one being ZK. Trade-offs, which I think is interesting. Do you want to take us through any of the trade-offs with these, or?
I can't actually see it enough. Sorry. Yeah.
All right. So main trade-offs is delays for finality. So some gas/bridge friction. If you need to go between the layer 1 and layer 2, there's some friction there. There's some gas fees, and user experience depends on bridging, right? So to get your money onto the layer 2 or get your tokens onto the layer 2 Arbitrum, you have to interact with a bridge. There's some security risks there, user friction risks. Some people don't understand how that works, but there's some trade-offs. Optimism being another popular layer 2, very similar to Arbitrum, but it has a different architecture. It's more aligned with the Ethereum layer 1 upgrades, and it's got some different development tools to build on it. So, main trade-offs there is the fee structures and the way they subsidize activity on the blockchain. So, a lot of these layer 2s, in order to get adoption, they've made their own token. They'll airdrop the token, or they'll offer the token as a reward for people using it or people building on it. Those are called subsidies. You can think of economic subsidies, same thing.
Right.
And it could come under pressure if the foundation or it doesn't manage it properly, I guess. So still some decentralization questions there, but again, these are pretty new. These have really only launched in 2020, 2019.
Yeah.
So
around that.
Yeah. So they're pretty new, and I don't even know if they went to mainnet. So we're under 5 years of these things existing, which is very, very new.
Yes, thank you. Edward just answered Donna. She said, what does TVL mean? That's total value locked.
Yes. So that means, Donna, that means the amount of money or tokens that are on
the chain.
So it can be represented in dollars or like ETH, but it's just an indication of liquidity and adoption and really economic security in some ways, because the more money there, the harder it is in some ways to hack it, but the bigger the prize if you can hack it, I guess. So it just is an indication of adoption, I would say.
Well, excuse me. I think it's interesting from an investment standpoint if you're looking to get into crypto and you're thinking of it like stock.
Yeah.
This is how you do your research into the technicals like you would a business. What is it? What is the product? What is it doing? Well, these are, infrastructure for a lot of other things. Are people using it? Are they not? TVL is a great thing to look at. And yeah, if you go to are we on the second page for layer 2?
Yeah, layer 2, Base coin. Yeah. So Base is actually what I would consider one of the most popular and well-adopted ones. This is Coinbase's layer 2. So Coinbase incubated and developed this internally and launched it to the public.
Not that long ago.
2021, I think.
I feel like it was more recent than that.
Yeah.
We'll have to look it up, but it feels like it was just like last year.
Yeah. I feel like it just caught adoption last year, really.
Yeah.
Like it probably took a couple years, but yeah, so Coinbase, many people don't know, they actually have built their own layer 2 on Ethereum, and a bunch of big names backing it, focus on ease of use, US regulatory compliance, aimed at onboarding that kind of billion user moment, right? Like similar to like the smartphone. This is what they're focusing on applications that allow like normal uses. Social media is a big one. Obviously trading. I think sport prediction markets, stuff like that, that is really aimed at just kind of a normal user. Not necessarily like a crypto native or somebody in DeFi or finance, but social media is a big one, and gaming too. So that's, in my opinion, that's been the most successful one, and probably the
Don't
most.
forget NFTs, Dan.
And NFTs, yeah.
A lot of NFTs on
Yeah.
base, music NFTs too.
I put NFTs and gaming together, I think, though.
Yeah.
In some ways.
Okay, I can sort of get on board with that.
Yeah.
A little different.
Yeah. They are different, but
I mean, well, very different.
I put
categorically. I
yeah,
guess
like I
you
put
can-
DeFi in its own category, but
Yeah.
I put NFTs and gaming sort of like together because they're more consumer apps.
Yeah.
They're not like DeFi to me. DeFi and like trading applications to me is a very specific use case, but NFTs and gaming is like anybody that doesn't necessarily
More abstract.
Yeah.
Yeah.
Or like if you're just interested in social media, gaming, or just kind of a techie, like
You've got like a culture bucket.
Yeah.
And then like the finance. Like.
people.
Yeah.
Yeah. Like, yeah, exactly. So,
Yeah.
and majority of the early adoption was this idea of DeFi or open finance or whatever, trading. But now we're seeing with these layer 2s, more consumer adoption in the culture social bucket, I would say, which is good. Because I think this is a bigger bucket, to be honest with you.
Retail, yeah, I agree.
Because if you think about how the internet tracks or mobile app stores track, like, sure, people put, whatever E-Trade or whatever.
Well, not everybody understands finance.
Right.
DeFi is pretty advanced.
Yeah, it's very.
But most people understand memes, artwork, games culture,
social media.
socializing.
Yeah.
So yeah, there's a lot there.
Yeah.
We've gone off route a little bit. And I want to say hi to everybody on X. We've got For Life Scott, Pensive Chepe, Caldone 678. Hello. And Jerry is on
Jerry's
X.
here.
What up, Jerry?
What's up, Jerry? So there's a couple others here. I think they all kind of have their different specialization. Like I see we have Immutable X here. That is a layer 2 specifically for gaming. So a lot of the tooling and the way it's designed is for people to build games on top of. So less general purpose, more toward a specific use case. So there's things like that a layer 2 can be as well.
And fun, hot off the press, Coinbase is exploring the launch of a token.
Is that public information?
Yes. I mean, yes.
It's really funny.
I don't have insider information at Coinbase. That would be cool if I did. But no, I did hear it on other publications.
Well, what I think is interesting, not to go off on a huge tangent here about Coinbase, but back in, you remember the 2022-23 like FTX blow up, Terra Luna blow up, kind of destroyed the industry until basically this past year.
Yeah.
At that time, Coinbase had just gone public in 2021, I think. And it traded up to like $300 a share, and then it crashed to $50.
Oof. Why didn't I buy it?
So I was deep in the weeds, and I was like, oh, Coinbase is launching Base. Like I had seen Jesse Pollack, the guy who developed it or kind of pioneered
It's
it
like
there.
the guy behind Base.
Yeah, I saw him at ETH Denver. I knew there was all this underlying parts of their business. It wasn't just this crypto company that was going to get swept away by the SEC, right? That was the narrative on Wall Street. I knew that wasn't true and that there was all this stuff coming. So yeah, I bought Coinbase stock at like $50, $60. So I just wanted to plug my my investment.
Your smart move. Well done.
Yeah.
Well done, Dan.
So
Good flex.
Yeah. So anyway, I want to bring up this picture you have.
Well, yeah, you can go to that link.
Yeah, let me just see that.
This is just we've shown this before on the show. I remember showing Ryan, and he hadn't seen it before, and he was like, what?
Okay, so can you explain kind of a little bit what this is?
So right now you're looking at ETH on the left, Bitcoin on the right. These are actual real-time transactions represented by South Park characters. They are at scale, so the larger the character, the larger the transaction. And you can see them being put into blocks, hence blockchain, and being processed on the network, okay? The network being the road. So all these blocks are now going down the street. And you can, if you click on one, it'll show you the transaction hash so that you can actually like go look at it on ETHScan here.
This is Bitcoin.
Oh, you're on Bitcoin. So if you go to...
So this is Ethereum. So
I'm wondering if I'm looking at a mirror image of what you have. For me, Ethereum's on the left.
Bitcoin's the orange one, Ethereum's the blue one. How
Yes, there you go.
So you could see that this block is bigger, it's slower, it's filling up more. This is there's different layers and different fees that you can do on ETH.
Well, and look at all the transactions in line, like waiting in queue.
Yeah, here we go.
So now you can see all these little characters running, and the bigger the character, the bigger the transaction. So find a big one or find a little one, click on the character itself, and there you go. You can see what they're doing. You can click on that hash, and it'll pull up EtherScan, and you can see what are they doing. I can't see because it's too small on my screen, but it's a really fun way to just visualize how the blockchain works.
Right.
And then if you go up and you can pick a different one.
Yeah, so I want to do, let's see, because I want to do
a different chain.
Yeah, here we go. Let's do Arbitrum, which is a layer 2, versus
ETH, layer 1.
Ethereum. So here's Arbitrum, right? So they're all essentially mailing. They're like kind of giving their package to this guy, getting on the escalator or movable walkway, right? And just going, look at how much quicker it is, right? It's kind of...
It's more efficient.
More efficient. See all these applications here that are on Arbitrum. And yeah, it essentially, they give the package, they give the envelope to the guy that's going to package it, the post office, whatever. And then they're kind of waiting in line to be...
They bulk
package it, yeah.
Yeah.
So look, see, he just took it and took it to Ethereum.
And now you could probably see that guy go over on the Ethereum blockchain, and then it settles over there. Oh.
Sorry about that. Yeah, so I just wanted to show the guy because it was kind of cut off, I think. So watch, once this fills up, he'll take it to Ethereum.
Yeah. I used to stalk this and try and find my own characters when I was having transactions go through. I'd be like, who am I? Yeah. Too much time on my hands back in the real trench days.
Blob. Okay. This is part of it. So this package, all these packages that this mailman will take and put to the Ethereum, it's called a data blob. So the way they're representing this on this system or this visualization is this little green character.
Love that.
If you click on it, it's a blob.
Someone's asking, can you show Solana? Solana. I don't think Solana.
On this one, I can't. There's no visualization on this particular tool or that we found, but I'll look around for it.
Yeah, we'll try and find something similar.
Yeah. Just want to move this down because you couldn't see here. I just want to show, so when it fills up and it gets packaged, they're taking it to Ethereum. So you'll see in a second here.
Oh, I see. You're not sharing the right. It's not capturing your whole thing.
There it is. See, he packages it up. He's the postman. He takes it to Ethereum. So just a simple, fun visualization for that. So let's go back here to the final slide.
And we can kind of fly through this because we kind of went over a lot of that.
Okay.
And we can post these slides later, so if anybody...
Yeah, we'll post the slides to Discord. We'll post the slides, maybe the newsletter. We'll grab a couple slides, but challenges, trade-offs, what to watch, kind of summing it all up. Security versus performance. Layer 2's inherent security from the base chain, Ethereum, but they introduce new attack services. User experience and liquidity, onboarding across layer 1, layer 2, and back can be confusing or risky. There's fragmented liquidity. It can kind of make it less efficient in some ways, depending. Decentralization and governance. Some L1s or L2s have more centralized sequencers or validators. So for trust, that matters. single point of failure, kind of what we were trying to avoid here. Regulation risk, especially for big chains or ones tightly bound to centralized entities, exchanges, parent companies, Coinbase. So there's still some trade-offs, still pretty new. Like I said, these are under 5 years old. Some are getting adoption, but yeah, I think that's kind of summing it all
Well, I
up.
guess we need to ask Donna, did we help answer the question, what's the difference between a layer 1 and a layer 2? Because if not, we have failed, and we can start all over again next week. But yeah, we have a lot of these. Oh, okay, important thing to differentiate is also coin versus token. A coin is the native currency of the blockchain. So like Ethereum, Bitcoin, Solana, those are coins. A token is launched on one of those chains. So like the TC token is launched on Solana. It's the token, not a coin. So I think that's an important thing to mentally understand as well.
I never really thought of it like that until recently either. I was just like, oh, I didn't really make the
They're
distinction.
synonymous. Yeah, no, they are different. And I'm trying to keep up with chat here. Let's see. Dan, what has more promise in 2026, L2 networks or the White Sox?
I would say L2 networks, depending on which L2 network there is. But hey, the White Sox will be back soon. Trust me.
Whoa.
Trust me. They made some moves in the front office. We've brought in some new ownership, albeit minority ownership, but new ownership is always good. And the fans are starving for a winner.
Okay.
So just whatever next season's win total is, bet the over.
All right. And then we had a question regarding the TC token. Downloaded the Tasty Crypto app today and wondered why TC isn't available, or maybe I couldn't find. Oh, okay. So the TC token that Dan and I launched is not in the wallet. It is launched through Bags app on the Solana blockchain. So if you have, we can also help answer these questions in our Discord more directly. So hop in over there, and you can find a link to the Discord at tastycrypto.com. And then Dan, if you want to jump down 2 slides. Also, sign up for our newsletter if you're not already on it, because we've got some great stuff. And we also just sent an email today. So if you're subscribed, go check your email. There's an opportunity to potentially earn some money for answering some questions, because we have a survey going out.
We're looking for your feedback. We need you to. We're working with a company that to give us some user research feedback on our crypto offering. If you sit on a quick meeting, an interview, you'll get paid some money.
Yep.
So to sign up for that, you would have already had to be a subscriber, but if you are a newsletter subscriber, check your email, because that went out today.
Check your email and pop back up to that other slide. If you're interested, set up recurring purchases, because those are now available for crypto at Tasty Trade, and most of the coins we just talked about today for those layer 1s are available to trade.
Awesome. So that's kind of it. That's basically it for today.
Yeah, we are overtime.
Yeah. We'll be back Monday.
Well, we'll be back on Friday, Dan. Don't
Beans
forget
will be
Beans.
on Friday on the Tasty Crypto Network.
Yep.
YouTube channel, X, Facebook, Instagram, whatever. We streamed all of them. We'll be doing some more with the TC token over there. So if you want to learn how to provide liquidity, if you want to watch us buy up the token, if you want to just get involved in that community, because there's a totally different side of this. I'm glad that some people have been asking about the token. Join us on Beans Friday.
9 a.m. Central.
9 a.m. Central. We're going to go through and do a lot more with the token. We do it every week. And things growing. Keep supporting it. Keep backing it. If you have any questions about it, let us know. And that's all I have for today. We'll see you next Monday on the Tasty Crypto Show. I'm Dan.
I'm Shelly.
Peace.
Peace.